If you follow a YouTube channel focused on finance and business, you've probably watched The Wolf of Wall Street several times. The movie is fascinating and has inspired many reckless salesmen around the world. However, one line from the movie still irks me, even after 7 years. An IPO, or initial public offering, is the first opportunity for the public to buy shares in a company. When the company goes public, we set the initial sale price and distribute the shares to our friends. Look, I know you might be lost for words, and that's fine, but if you were like me, you'd be thinking the same thing. So okay, Jordan Belfort himself has said that the movie is only superficially based on the book he wrote, and the book in turn only touches lightly on reality. Many things were deliberately omitted from the book because if they were included, they could be considered evidence of crimes. Likewise, the film left out many of these activities since Martin Scorsese is an expert at portraying the rise and fall of organized crime figures without delving into financial market fraud. So come on, it's time to understand how money really works and take a closer look at Stratton Oakmont's dubious operations. Let's find out how Belfort managed to accumulate almost $1 million a week with illicit stock gains. I'd like to take this opportunity to thank the members of the channel and the supporters on Patreon, who make it possible to create videos about financial fraud, even if they are demonetized. If you want to support more content like this, consider contributing on either platform. Belfort's career really took off after he was fired from Ifs Rothschild, a stock brokerage in New York. Before the 2000s, buying shares wasn't as simple as going online and typing in a symbol. People called real brokers and passed on their buying and selling instructions. Most of the time, it was the broker who phoned clients to suggest which stocks to buy or sell. To get information about the market in 2021, you just have to Google it. But in the 1980s, you had to wait for the next day's newspaper or call your broker to find out what was new in the market. As Matthew McConaughey astutely observed, nobody, not even Warren Buffett or Jimmy Buffett, knows whether a stock is going to go up, down, or sideways. And brokers can't be sure either. Stockbrokers used to earn hard cash through commissions on the trades they processed. That's right, they pocketed significant commissions for every trade they made. Nowadays, we're used to brokers who don't charge commissions, but that wasn't the case in the 90s. Back then, brokerage fees could be as much as 2% of the total value of transactions. Of this amount, the individual broker kept 1%, while the brokerage firm kept the other 1%. Jordan Belfort, portrayed in The Wolf of Wall Street, actually worked for several firms that operated in a similar way. The film highlights the environment of these over-the-counter brokers, which differ greatly from foreign exchange brokers. Foreign exchange brokers, such as Ifs Rothschild, facilitated trades on the public exchanges and had teams on the floor of the New York Stock Exchange executing trades for their clients, with brokers transmitting orders directly from their offices. Although this system could still be exploited by unscrupulous brokers who pressured their clients into making too many trades to increase their commissions, the exchange exercised some control over all participants to ensure that things didn't get out of hand. If a brokerage firm or an individual broker was considered to be damaging to the exchange's reputation, the exchange had the power to exclude them from the trading floor, which would be devastating for these brokerage firms as they would lose the ability to carry out trades. OTC brokers, on the other hand, did not use the services of a formal exchange, which eliminated much of the associated regulation and supervision. This allowed for a more direct approach. I could, for example, ask for $1 million to fund a new radar technology with military and civilian applications, and the OTC broker could accept, but on the condition that it kept 50% of the funds raised. At best, these companies were desperate for funding to make their ideas viable. At worst, they were trying to cheat investors by using any money raised fraudulently. And as for the 50% figure mentioned, it was a bit of cinematic exaggeration. In reality, the OTC brokers probably dealt with different percentages. Receiving just 10% to 20% commission on these deals may not seem like much, but it's worth remembering that any company that needs to offer such a high cut to a broker just to raise capital is probably not a good investment. That's why Jordan Belfort and his team used aggressive sales tactics with inexperienced investors. Jordan eventually founded Stratton Oakmont, a subsidiary of Stratton Securities, which was a small brokerage capable of trading both over-the-counter and with listed companies. Together with his co-founders, Brian Blake and Danny Porish, portrayed as Donny Azoff in the 2013 film, Jordan acquired the company and began to revamp its operations. Belfort was making a good amount of money selling worthless shares, but he had bigger ambitions. He set up a team of brokers who would sell any stock he recommended very aggressively. Before that, Belfort would activate trusted contacts who would buy a large number of shares in a small company, usually with a market value of less than $100 million. With his contacts, nicknamed rat holes, owning a significant slice of the company, he instructed his brokers to sell these shares to the public, creating a rush that drove up the price. This increase made it easier to attract new investors. This stock has doubled in value in the last week. Get in now, or you'll miss out. When the price reached a certain level, Belfort ordered his rat holes to start selling. Meanwhile, Belfort's company made it extremely difficult for regular customers to sell their shares. Brokers ignored calls from investors who wanted to sell or purposely missed trading orders, giving the rat holes time to liquidate their positions. When investors finally managed to sell, the share price had already collapsed. The rat holes would hand over the profit to Belfort, keeping a small part for themselves. This scam reached new heights when Stratton Oakmont began taking companies public. An initial public offering, IPO, is when a company is listed for the first time on a public stock exchange, and there are a number of rules and regulations in this process. The main advantage for the company is the ease of raising capital on the public market. To do this, companies hire an underwriting firm to guide them through the process, which also assumes part of the risk of the operation. The underwriting firm is responsible for ensuring the success of the IPO, which, when successful, can be extremely lucrative. For an IPO to be considered successful, all the shares offered by the company must be sold at or above the agreed price. Normally, companies hire investment banks to manage the subscription, but Stratton Oakmont has managed to attract a number of companies to use its services. One might think that the reintroduction of public stock exchanges into the process would have hampered Belfort's strategies. Originally, he preferred to trade shares on the over-the-counter market to avoid the regulation and scrutiny of the public markets. However, Jordan was undeterred. He created a system that took advantage of both environments. First, he directed his allies to buy shares in a company about to go public. The company would then debut on the public market, and Jordan would mobilize his team of brokers to sell the IPO en masse, which raised the share price quickly. The difference now was that because it was publicly listed, the stock attracted the attention of investors outside Stratton Oakmont. These new investors, seeing the IPO rise by 50% right at the opening, wanted in on the action. Jordan's allies then quietly sold their shares, securing a considerable profit. Jordan skillfully combined the less regulated environment of the over-the-counter market with the trust that investors place in public stocks, creating an effective and lucrative scam. This is how he managed to make an impressive $22 billion in a short period of time. For those who haven't noticed, this is what is known as pump and dump, the method that Jordan Belfort used to amass millions. It seemed that this type of scheme was becoming obsolete with the emergence of online stock trading platforms and easy access to information, which protected investors from brokers promoting worthless companies. As always, a special thanks to the members of my channel and the supporters on Patreon for making it possible to continue the education on how money really works. Unfortunately, the growth of cryptocurrency markets, which are poorly regulated, has brought back pump and dump schemes. The only difference is that today, instead of brokers, we have online communities and influencers. Small cap stocks have been replaced by meme cryptocurrencies. Another crucial part of the movie is how Jordan hid his money after winning it. I won't have time to detail that in this video, but I've already made a full video explaining how you could do that if you find yourself with a significant amount of ill-gotten gains. So check out that video if you think it might be relevant to you.